Welcome to the 3Edge Quarterly Webinar for the first quarter of 2024. I'm Fritz Folts, the Chief Investment Strategist here at 3Edge, and joining me here once again today is Steve Cucchiaro, the CEO and Chief Investment Officer here at 3Edge Asset Management. Today, Steve and I will look back and review the first quarter of 2024. Then Steve will share our current outlook for the global capital markets, and we will leave time for your questions at the end of the presentation. Submitting questions is straightforward. You simply fill in the Q&A box there on your screen and hit submit. If we don't have time to answer all the questions during the webinar, we'll be sure to follow up and answer the questions via email after the webinar. We do have a lot to cover today, so let's get started. And as we do at the beginning of each quarter, just a few firm highlights. As a reminder, what we do here at 3Edge, we are a tactical, multi-asset class investment management firm with a strong focus on risk management. And again, being tactical simply means that we're making changes to the portfolio as our outlook for the market changes over time. And the changes are based on the output from a proprietary research model, which is the result of over 40 years of study of the global capital markets. And again, being a multi-asset firm simply means that we are able to invest beyond just stocks and bonds. We can invest in real assets such as commodities and gold, and we create our portfolios through index exchange traded funds. We currently manage approximately $1.8 billion in assets, and we have now established a nationwide footprint. We have offices in Boston, Naples, Florida, and Los Angeles. An important feature of our 3Edge investment approach, we have continued to expand our capabilities in terms of tax loss harvesting and financial planning. And briefly, just to touch on the tax loss harvesting program, these strategies are intended to reduce the potential impact of taxes on taxable investment portfolios and therefore improve after-tax investment returns. And here at 3Edge, our experienced investment committee, our research, and our trading teams, along with the assistance of portfolio management software technology, have developed a disciplined, opportunistic, and proactive tax loss harvesting program, which basically involves selling investments that have decreased in value, thereby generating a capital loss, and applying that loss to offset capital gains from sales of investments that have increased in value. And again, the goal of tax loss harvesting is to, where practical, and seek to minimize taxes, maximize after-tax returns for investors so they can keep more of what they earn in their taxable accounts. We've also continued to build our capacity to make our investment solutions available on what are called turnkey asset management platforms, or TAMPs. And these are utilized by many registered investment advisory firms. And this is how they gain access to our 3Edge solutions. We've recently added two platforms. That would be Atria Wealth Solutions and Sanctuary Wealth. And our assets continue to grow on our existing TAMP platforms at Orion, at Cambridge, LPL, Adhesion, Potomac, SmartX, and InvestNet. We've also continued to focus on developing thought leadership capabilities through our 3Edge video series, our weekly 3Edge Week in Review, and View from the Edge videos. And our viewership and subscriber base for our YouTube videos continues to grow. We continue to hear from clients and listeners about how they value our videos as a way to remain informed as to what is going on in the markets. And quite frankly, we believe that information is power, particularly since there is so much noise out there in the financial media. So now let's look at what has happened in the global capital markets over the course of the first 3 months of 2024. And as we can see from this chart, all the major asset classes performed positively in Q1, with the exception of U.S. Treasuries, of U.S. bonds. The big story during the quarter was the strong performance of global equity markets, which increased by over 8%. However, thus far in April, we have seen global equities give back much of the gains that they generated in the first quarter. And year to date, global equities are currently now up just over 4%. The story that didn't get as much attention in the first quarter was a strong 3 months of investment performance in the price of gold, which was up over 7% in the first quarter. And now here in mid-April, gold is up almost 15% year to date. As I mentioned, U.S. Treasury bonds suffered losses in the first quarter. 7 to 10-year U.S. Treasury notes declined by around 1.3%, And bonds are having a very difficult month here in April. And U.S. Treasuries in the 7 to 10-year maturity range are now down approximately 4% year to date. Commodities had positive performance in the first quarter. In many ways, that was driven by increase in oil prices and concerns about the potential for the current conflict in the Middle East to escalate. And after a positive first quarter, commodities are up over or around 5% year to date. In terms of investment performance, we've shown this slide in the past, and it's just as relevant today. And the point of the slide is to address how investors have become enamored of the performance of the S&P 500 throughout 2023 and then the first quarter of 2024. But if we look back over a slightly longer time frame, and that would include the downturn in the equity markets in 2022, we see that from January 1, 2022, up through the end of March in the left column, so the end of the first quarter, and then the column to the right is from January 2022 up through the 15th of April, I believe, 15th of April, we see the performance is quite different. It's telling us a quite different story because the performance of the S&P through the middle of this month, going back to Jan of 2022, is 4.2%. The NASDAQ is up just about 4.3%. And these returns include the so-called Magnificent Seven stocks that performed so well in 2023. Another aspect of the chart points out how fixed income and bond investments have really suffered over the past 2+ years, with 7 to 10-year U.S. Treasuries as of the middle of this month down over 7%. Cash has returned 3.4%, commodities 8.5%, and the top performing asset class in the chart here is gold, which is up almost 12% on an average annual return basis going back to January 2022. And the point of the chart is to show that if we take a step back of a slightly longer term perspective, we also gain more realistic understanding of the performance of the U.S. equity market since October of last year in particular. So now let's look at the performance of our core 3-edge strategies. And this slide shows the performance of our core strategies. That's 3-edge conservative, total return, and growth. The line charts show the performance of the 3-edge strategies versus their benchmark since inception. In the case of 3-edge conservative, since inception, conservative does trail behind its benchmark, but by less than 1%. And if we look at the numbers in the columns below the line charts, we see that the maximum drawdown of 3-edge conservative, is less than 1/3 of the maximum drawdown of its benchmark. And now let's take a look at the total return strategy, which since inception has actually outperformed its benchmark and has done so with less than half the risk as measured by maximum drawdown. Lastly, on the far right, we see the 3-edge growth strategy, which since inception, 3-edge growth has underperformed its benchmark. Excuse me, one sec. Better. 3-edge growth has underperformed its benchmark, but it's also taken about half the risk of the benchmark. And taken together, these charts serve to illustrate what we set out to do at 3-edge, and that is to provide the best possible investment returns, taking the least amount of investment risk possible, or as we like to say, we seek to generate attractive risk-adjusted returns over full market cycles. Now, moving on, this next chart shows the same information as the prior one for some of our other 3-edge investment solutions, including our 3-edge Income Plus, 3-edge Global Equity, and International Equity. These strategies have become quite popular with both advisors and our clients. 3-edge Income Plus is driven by the same 3-edge proprietary research model, which drives all of our investment solutions. And the strategy seeks to generate income with an active tactical approach and broad diversification. And while the strategy does seek yield opportunities, it pays careful attention to risk by making tactical changes based on our proprietary model. And investment exposure, as with other strategies, is achieved through use of index exchange traded funds. And as of the end of 2023, the strategy had an indicated yield of over 9%. The other two strategies on the slide are 3-Edge Global Equity and 3-Edge International Equity strategies. And these two strategies, as I mentioned, have become quite popular with clients and advisors that we work with. And oftentimes advisors will combine one of these all equity strategies with one of our core strategies, such as conservative or total return. And the combination of one of our 3-Edge all equity strategies with one of our 3-Edge core strategies, such as conservative or total return, can create a blended portfolio seeking to achieve returns with less risk. And now I'll leave you with one last investment performance slide. And this slide shows the performance since inception of the 3-Edge conservative strategy versus the S&P 500 aggregate bond index. So our conservative strategy is the line that's in blue, and the aggregate bond index is the line that is in gold. And many of the advisors that we work with utilize conservative as a substitute for core bonds. And as this chart shows, our conservative strategy has outperformed the S&P 500 aggregate bond index since inception. And if you look to the left, you see that it's done so with less than 1/3 the risk of the aggregate bond index. And the main point of this slide is not necessarily to point out past performance, but rather have people consider that from 1981 to 2020, we experienced the biggest bond market rally in history. Rates steadily declined over a period of 4 decades. However, going forward from here, things may be very different. Bonds may not provide the same experience that they have in the past, and that is why our 3-Edge conservative strategy could be an excellent substitute for a traditional bond portfolio. So with that, I will hand things over to Steve, who will provide our current market outlook, after which, again, we'll get to as many questions as we possibly can. If we don't have time for all the questions, we will make sure to reply via email. So Steve, over to you.
Thank you, Fritz. What I'd like to do is to start off with the outlook for the U.S. stock market. And it's been a classic battle between the bulls and the bears, the bulls being more optimistic about the U.S. market and the bears being more pessimistic over the last couple of years. If we go back to 2022, we find that the bears had their way in the stock market. Sometimes people forget that the S&P 500 index of U.S. stocks at one point was down nearly 25% during that year and closed down nearly 20%. So the bears had their way. In 2023, it was a bit of a tug of war until later in the year when the bulls were clearly in charge. And so far in the first quarter of 2024, the bulls absolutely had their way. In fact, by the end of the quarter, by the end of March, sentiment indicators showed that the percentage of investors that were bullish neared all-time highs, and the percentage of investors, consequently, that were bearish were near as low as it gets. So that was kind of a clue that we might have been close to a market top with so many people being so bullish at the end of the quarter. Now, there are reasons why the bullish camp feels that way, and there are also reasons why the bearish camp feels why the market might not be so strong going forward. So let's dive into that. On the bullish side, the argument is that the economy has been very strong and resilient. Corporate earnings have been rising. Inflation has fallen from its peak of 9%. There's a big expectation that the Fed will cut rates this year. And there's been this positive momentum in the stock market where the higher the stock market goes, more encouraged people want to participate and they buy, and that causes the stock market to go higher, brings more people into the market. It's kind of a self-perpetuating motion following the positive trend. And that's been driving the bullish narrative. On the other side, we've had monetary tightening, and it seems to have had no effect on the market. But there's always a long and variable lag after monetary policy changes. And looking at the average lag after monetary tightening, it's really not expected to start impacting the markets of the economy till about now, or sometime between now and the end of the year. So that slowdown could still be ahead. Secondly, there's certainly an increase in geopolitical risk. And if the Middle East doesn't de-escalate, but in fact escalates from here, we could see oil prices rising even further than they have. And oil prices rise over $100 a barrel. That could be very bad for the markets and the economy, because it'd be like a big tax on the global markets. The Fed has really hoped, and investors really hope, that inflation just comes down steadily to the 2% target so they can feel comfortable lowering interest rates. But last few inflation reports, inflation has been sticky, and it's having a hard time getting much below 3%. And the last CPI report was 3.5%. And just this week, while Chairman Powell has indicated earlier that he's really anxious to start lowering rates because he feels that they're restrictive, he just came out more recently and said, until inflation shows more evidence that it is coming down to 2%, that he might have to hold off on those rate cuts. And then finally, when you've had a market that's done so well for so long, and with barely a correction, when you do start to get a correction, that starts to encourage people to do profit taking. That sends that momentum in reverse, and that could beget more selling. So something to be cautious about. Now, I'd like to look at one of the arguments for why the market's expected to continue to do well, and that is because corporate earnings have done very well. And here we see on the chart the performance of companies and the performance of the stock market. The orange shows the growth in company sales, and this is for all the companies in the S&P 500 index, since the last recession, which was in 2009. And you can see there's been a nice steady gain in corporate sales since that period. And we know that stock prices over long periods of time followed the fundamentals. Now, corporate earnings in the gray have done even better, and companies have been able to increase their margins. Companies have benefited from some productivity gains, but even more importantly, from incredibly low interest rates over much of this period and big tax cuts. And that has allowed earnings to go up even faster than sales. Now, over long periods of time, earnings and sales would grow at the same rate, but in shorter periods, you can get earnings growing more quickly if profit margins expand, or less quickly if they don't. And what we've seen is the profit margins now is about as high as they've ever been in history. The only exception is the summer of 1929, which is a little bit ominous because that was right before the crash of 29, the Great Depression. Now, for the argument that stocks can keep going up because earnings keep going up, there's one big fly in the ointment. That's the blue line, and that's the price per share compared with earnings per share in gray and sales per share in orange. What we've seen is that since the recession, price per share has gone up much more quickly and much further in advance than earnings or sales. And we know two things. One is that markets can get overvalued, and overvalued markets can continue to be overvalued for longer than people using logic or fundamentals might expect. But we also know for certainty that eventually all these lines will converge. And it's like a basketball player jumping up off the ground, defying gravity for a moment and maybe dunking the ball, but you know that eventually they come back to the ground. And this blue line does have to converge at some point with the gray and orange lines. So this is a gap that we feel is unsustainable. And while it doesn't mean that the market has to decline today or tomorrow, it does mean that eventually there's going to be an adjustment. That's why we remain cautious. This shows the same phenomenon over the last 100 years, just to show how price per share, earnings per share, sales per share are necessarily directly related and linked. When you own stock, you own your share of the company's business, whether it's sales revenue or profits. And the price you pay is to own that stock. The intrinsic value is tied to the sales or earnings. The blue line is way above those other lines, as you can see currently. And the only times it's been way above those other lines were right before the crash of 1929, the Great Depression, all the way on the left. Another time in the year 2000, right before the tech stock bubble burst. And then again, right before the financial crisis, the global financial crisis of 2008. So more caution. Now, we'd like to review the seasons of the market to look at the big picture and see where are the markets. We know that they typically cycle through different phases, and we use an analogy of the seasons as the phases. So we think of winter as your recession or economic downturn. We think of spring is your economic recovery. We think of summer as when the economy gets overheated. We think of the fall as when it begins to slow again. And a lot of this is driven by monetary policy in the Fed. When the Fed sees the economy is in big trouble, they decide it's time to add stimulus to try to rescue the economy. But because of the lags in monetary policy, it takes a long time for that to kick in. So the economic downturn often lasts longer than they would like. That means that they keep piling in more and more stimulus. We start to see the recovery happen in the springtime, and that's a great period for equities. And then that continues into the summer, where the economy now starts to get overheated because there's all that extra stimulus pumping into the economy. And then often too late, like what happened in the last cycle, the Fed realizes that they've overdone it, inflation takes root, and now they've got to start to slow things down. So they start to tighten monetary policy. But because they always start too late, economy gets more overheated. And then finally, that tight monetary policy kicks in, and then you have a credit contraction, and that begins to slow the economy. And if it's overdone, that turns into your next recession. So the cycle is quite prominent over time. And we know that certain asset classes outperform at different phases of the cycle. All the research that we've done points strongly to the fact that we've been in late summer. We've seen the inflation take off. We've seen unemployment go to near all-time lows. We've seen the stock market do extremely well. And we would say we're in very much the late cycle, near the end of the stock market rally that's gone on for quite a while now. And the next thing to worry about is moving into the fall or into the credit contraction, which will not be kind to the equity market. However, with added fiscal stimulus, we've been able to stay in summer longer than many have expected. Now, the optimistic or bullish market narrative is just the opposite. The markets are hoping and pricing in that, no, we're on the other side where it's springtime, and that we've been able to dodge any credit contraction, we've been able to dodge any recession, and we've got a long runway for stocks to continue to go up. But we certainly question that thesis. Number one, at that point in the cycle, you'd expect, and you always see unemployment very high, and the Fed coming in to try to lower unemployment. And right now, unemployment is very low, much like you would expect in late summer. And also, in the springtime, and the crux between winter and spring, bonds do very, very well at that point. Bonds have been doing horribly. Commodities do poorly at that point in late winter, early spring, and commodities and gold have been doing very well, like you'd expect in late summer. So we think that we're in the late summer and we're not out of the woods yet. I want to talk about gold. As Fritz mentioned, gold has performed really quite well lately. And we want to explore some of the reasons why. So there are economic reasons that affect gold, economic factors that affect gold, and there are some non-economic factors that affect gold. First, let's talk about some of the most important economic factors. One thing we know about gold over time is that it moves inversely to changes in real or inflation-adjusted rates. An inflation-adjusted rate is simply taking the 10-year bond yield, subtracting the market's expectation for inflation looking forward. And we can always get that by looking at the 10-year TIPS yield, or Treasury Inflation-Protected Security Yield. What you'll notice in this chart is that when the blue line moves down, in other words, when real rates are coming down, gold becomes much more attractive and rises. When real rates move up, meaning that you get rewarded more for holding treasuries or paper dollars, gold tends to move down or flat. And this pattern has gone on for a long time. Lately, real rates have moved up quite a bit from their lows in 2021 and then became a bit volatile here. But gold still is, at worst, was flat, and now it's climbing. So one thing we feel is that if real rates start to move down again, that could be further support for gold prices. And one way that real rates might move down is that right now the market expectation for inflation over the long term looking forward is that it will go down close to that 2% target that the Fed is talking about. Should that inflation expectation change, should investors throw in the towel and say, maybe inflation is going to be stuck at 3% or higher, then that blue line could move down, and that could further propel gold prices to go up. Or the Fed comes in and forces interest rates, 10-year interest rates, by going back into quantitative easing, and forces them lower, closer to where inflation expectations are. That blue line could also go down and help gold. Now, let's look at a more current reason why gold's been going up. And this has been because central banks have been buying massive quantities of gold ever since the invasion of Ukraine by Russia. And after the invasion, the U.S. implied sanctions on Russia. And this made Russia and a lot of its friends quite nervous. And there are a lot of central banks like China that have a massive amount of their reserves in U.S. treasuries. And they start to worry, well, what if there are sanctions against them? Would they be able to cash in their treasuries? So we've seen a big swapping of U.S. dollars and U.S. treasuries into gold. You can see the purchases of gold have climbed very sharply. This has helped gold prices go up. And with geopolitical conflict getting worse, not better, this could certainly continue. Now, some people think gold is not a real investment and doesn't belong in a portfolio. Others think maybe for short-term trade if things get really nervous. And we'd like to dispel that notion and look longer term. So we picked, over the last 25 years, gold in the gold line has actually outperformed the S&P 500 index, including all dividends reinvested. And that really shocks a lot of people. But that's truth. That's what the data shows. So another way to think of it is that you see the black line, that's the S&P 500 index. It's climbed tremendously since 1999. And it certainly climbed a lot in 1999, a lot from 2002 to 2007, and a whole bunch from 2009 to the present. So you can see that black line going up sharply. But that's priced in US dollars. And during a lot of this period, the Fed has been printing lots and lots of money to try to stimulate the economy and protect the markets. And in fact, there was a 3-year period from 2020 to 2023 where the Fed printed more money or increased its balance sheet more than the previous 107 years. So another way to look at this chart is the orange line, which shows if we priced the U.S. stock market, not in terms of U.S. dollars that could be manipulated, but in terms of gold, which can't be manipulated, you see that the U.S. stock market was really quite flat. In fact, not even quite back to the level it was in early 1999. Just another way to think about it. And then finally, as Fritz mentioned earlier, we've been witnesses of the greatest bull market in bonds in the history of civilization from 1981 to 2020. The bond market has never done that well anywhere. And it's been a tremendous bull market. And yet most investors and most investment managers really cut their teeth and learned about investing and developed their policies during that period, which might have seemed normal at the time. It was a massive bull market in bonds that ended when 10-year treasuries went to 0.5% in August of 2020. And so during that period, investors learned that bonds were a great hedge to include in a diversified portfolio in case something went wrong with equities. And that was true for those years. What's not true is the period before 1981. In fact, from 1940 to 1981, bonds were a terrible hedge to include in a portfolio trying to hedge equities because bonds lost half your value over that 40-year period when compared with inflation. And we think that when the bull market ended in bonds in August 2020, bonds would no longer be the best hedge in a diversified portfolio compared with gold. So here we look at the comparison of gold and bonds, and we can see gold greatly outperforming bonds. So we think this can continue in a period of rising inflation and also rising debt levels. And despite the fact that the world is not in a global recession right now, debt levels all over the world, both government and corporate debt, are rising very sharply. So there's a lot of talk about inflation. The optimists think that inflation is bumpy, but it's coming down to 2%. Pessimists think that might be wishful thinking. So while there are a lot of confusing statistics about inflation, there are some clear leading indicators. So let's look at those. First, inflation cycle starts with big, strong monetary and or fiscal stimulus. And we've had that in boatloads and almost unprecedented, or in fact, unprecedented. Then gold prices start to pick up all that stimulus. You see gold prices rising. We have seen record high gold prices now. Then with a lag, you'll start to see it be picked up in commodity and producer prices. And commodities have been in a slumber for many years since the financial recession in 2009, but more recently are now picking up. And then it'll finally feed into consumer prices. And the last few consumer price reports have been higher than expected. And then finally, it gets to what's called core consumer inflation, which is inflation excluding food and energy. And that's the lagging of all the inflation indicators. And ironically, that's the one that the Fed watches. And the reason why is that it's the more stable of the indicators because you exclude food and energy. But it's the most lagging indicator. And that's why sometimes Fed policy is like looking in a rearview mirror to try to determine what to do elsewhere and why they're often late to make moves. And they were very late making moves when inflation picked up. And it'll remain to be seen if they're going to be late when inflation eventually falls down the road. So this inflation cycle, the current inflation cycle is in blue. And we're comparing it with inflation cycles in the 1940s and the 1970s. And you can see it's tracking those inflation cycles very well. We came from a very low level, hit a peak, fallen. And in the other cycles, the government and the Fed declared victory, and inflation seemed to be more stable, but then picked up again because they declared victory prematurely. And a lot of the same underlying causes were still there. And the inflation cycle got even worse down the road. They had to hike rates even worse to bring it back down again. So that's one reason why the Fed is very concerned not to cut rates too early. On the other hand, they feel like if they wait too long, they're going to cause the next recession. So to summarize, the Fed really would like to cut rates. They think it's overly restrictive. They'd like to bring them down. They've telegraphed that. But if they do cut rates prematurely, they could cause a rebound in inflation and a worse problem down. Second, based on our research, we feel that the markets are more overvalued than most investors recognize and most investment professionals recognize, because we think that it's much more sound to look at the difference in the price per share versus sales than it is looking at PE ratios, which often give very misleading signals, turning points like in 1982 when PE ratios were actually high and it said stay out of the market, yet it was the beginning of one of the biggest bull markets ever. We think it's giving a misleading signal again. So we think that it's not a time to be complacent in that if markets correct back to fair value, because markets are so overvalued, we fear that the correction could be more than what people might normally expect. We also think that in a diversified portfolio that does include equities, you want to hedge those equities with in a targeted way. In long-term bonds, we keep at our minimum end of our range, and we more emphasize hedges in gold and Treasury inflation-protected securities, which so far have proven to be much better hedges, and we think that'll continue. Also, should we get a correction, it will be very prudent to have money in short-term treasuries, which are earning over 5% right now, more than long-term bonds, and without the risk of long-term bonds should interest rates keep going up. And it provides dry powder so that if we do get a big correction and people are forced to sell at the bottom, we have the dry powder to be able to scoop up those bargains and then make a very good return after the correction. And then finally, as Fritz showed, the world has really changed, and a lot of bond investors are stuck into the bull market thinking. And we really do believe that more and more investors would do well to diversify away from bonds for their safe part of their portfolios or a safe part of their personal monies, and consider a much more diversified strategy, that's three-edge conservative, that has enough diversity to really count for a lot of different scenarios, not just interest rates and inflation coming down. And with that, I'll turn it back to Fritz, and we'll have a Q&A period.
Perfect. That was great, Steve. Thank you. So let's get to some of these questions. A couple of them I can combine, but I love the first question here, which is asking about interest rates. And I do want to say before I ask the question that I do speak with investors, and they often ask, when are rates going back to normal? And it's important to remember that a lot of people think that normal is rates at zero. And that's probably not where we're going. But the question is, it's a very good question. When are rates going back to normal, which I believe he's asking, are rates going to come down from here? So how would you address that?
So I think you bring up a good point, Fritz. Right now, rates are even a little bit below normal or average if you look over history. You can argue the short-term rates are a little bit above average, long-term rates a little bit below, close to average, not too different. It was a few years ago when rates were so extraordinary that if you looked at all the global interest rates back in 2020, they were at 5,000-year lows, never before seen in the history of civilization. And there are people who have done research going back thousands of years, getting all the data and evidence they can get. So that was truly abnormal. This is more normal. When inflation is going down, and inflation goes to zero or even negative, then you can get lower rates. But even what's normal is that rates are usually some premium over and above inflation. So for rates to go back to 0.5% like they were in the middle of July, that would just be really abnormal, really extraordinary. Because we think inflation pressures are going to continue, we have inflation pressures from many sources. We have wages now higher than they were, say, 3 years ago. We have geopolitical risk and commodity prices going up and the threat of oil prices going up. We have costs due to climate change. We have increased costs due to tariff wars and trade wars. Let's talk about that getting worse, not better. We think there's a lot of pressure for inflation not to go back to zero, but to stay higher. So we think that they're not going back to zero. Now, there's a lot of anticipation about the Fed cutting rates, and they really want to cut rates. And by their own internal models, their short-term rates are too high. Like I said, they're afraid to cut them before inflation comes down to 2%, but they're afraid to keep them where they are because based on their models, eventually there will be a recession. So they're really struggling, hoping for some good inflation reports to allow them to come down without spooking the markets on inflation. So it's still reasonable to expect that they will try to cut rates sometime this year. Now, the other reason why they might cut rates is if all of a sudden there's a black swan and which is an unpredictable negative event that affects the markets. If we get a big stock market correction, if all of a sudden the economy unexpectedly goes into recession, if unemployment starts to climb rapidly after being so well behaved so long, they will certainly cut rates, but those won't be for good reasons. Those will be for bad reasons.
So I know that you talked about gold a lot, but I have a lot of questions on gold. So could you just, really briefly summarize, the outlook for gold and why gold could continue to go higher from here, just to sort of summarize that outlook?
Sure. Well, first of all, one known fact about gold is most of it's already mined above the ground and stored in vaults and central banks and commercial banks. And there's a little bit of mining that goes on, and that pretty much offsets the little bit of jewelry consumption that happens. But when we talk about gold, we're talking about it as a monetary asset. And gold has been a form of money for thousands of years. And gold has held its value much better than any paper currency that's ever been invented, including the US dollar. So we always advocate owning a little bit of gold because there are times when the black swan does come and all assets get crushed and gold's the only thing that's going up and helping your portfolio. Now, having said that, we do think that gold right now is in a very interesting point. And as I mentioned, the central banks have been buying it. There's a lot more geopolitical unrest. The other reason is that government debt is going through the roof. And at some point, the interest expense on the government debt, just the U.S. alone, the other countries have it just as bad or even worse, but in the U.S. alone, because interest rates are higher now, we are no longer paying a small amount to pay the interest on the debt. We are now paying, our budget is going to be more than the whole defense budget in the U.S. And at the current rates, it's going to be more than the whole entitlement budget. And so there could be a period where the government comes in and says, Fed, you've got to help us out. We can't afford to pay so much on interest on our debt because our debt keeps going up and up. Bring interest rates down, constrain interest rates from going up any higher, bring them down like they've done in the past. And so if they constrain interest rates and bring them down closer to inflation, then gold could really go through the roof, because that means real or inflation-adjusted interest rates are going down. I don't know if there was a second part of the question, but
no, that's good. We got a slew of questions about gold, which makes sense. It's been in the news a lot, so I think it was just helpful that you were able to summarize the outlook. Here's a question that gets outside of the U.S., which is Japan, and that market has done quite well, finally getting back to where it was decades ago. But there's always a question of, well, what about the Japanese yen? Because that will influence investments in Japanese equities. So could you give a little bit of your thinking about Japanese equity markets? They've come a long way, and how the risk of what could happen to the yen might impact that investment.
Well, Japan is a great example of the whole adage that stocks only go up. If you hold them long enough, you always make money. Well, the Japanese stock market was the darling of the world in the 1980s. It peaked at the very end of 1989, first trading day of 1990, and then fell sharply. And only recently is it back to the levels it was, over 34, 35 years ago. It's extraordinary. And so it's taken a long time to come back. Japanese investors have been spooked that whole time and swore never to buy equities again, but now they've started to come back. And in Japanese equities, because of that negative psychology, are much more favorably valued than, say, U.S. equities, which are highly overvalued relative to fundamentals. Now, when you buy Japanese stocks, unless they're hedged, you're also getting exposure to Japanese yen. The Japanese yen has fallen a tremendous amount over the last few years. And by some measures, it's extremely undervalued and attractive. So one advantage by buying Japanese stocks is you buy an undervalued yen, and when it eventually appreciates, you can gain not only with the Japanese stocks, but with the Japanese yen. However, something disappointing happened recently. And that was that every time the Japanese yen fell to 152 to the dollar, 150 yen to the dollar, the government would protect it there, it would rebound, and would go back up again. And then it would fall, they'd protect it would go back up again. So a lot of traders expected they would continue to hold the line at 152. And just recently, that red line has slipped, and now the Japanese yen is back down to about 154. So there's some speculation that they're not going to continue to support the yen. They're going to let it fall more. That will help over time Japanese exporters be even more competitive in the global markets. But in the short time, if that were to continue and say fall all the way to 160, then that would detract from the return on Japanese stocks that are not hedged. Having said all that, at some point, Japanese yen usually does well in bad times. It's considered a safe haven because Japanese have a trade surplus. And also, the further it falls, more undervalued it gets. So it's a long-term play. It's not such a bad thing to have exposure to Japanese yen, but it could be trouble in the short term.
Excellent. One more question I want to fit in here because it's a great question. And the question is, which of your core strategies do you recommend if we are in the fall of the investment cycle of the season of the market? My quick answer to that would probably depend on each individual investor, but
yes,
I like the question in terms of the season of the market. So what would you say about that?
That's right. Sometimes the cycles move quickly, sometimes more slowly. So it's very important to go back and think about the individual client and what is the time horizon of that individual client. If it's 3 years or less, then I would say that it would be more prudent if we enter the fall and then proceed to the winter to be in the conservative strategy. That would have the greatest chance of minimizing any drawdown and holding your wealth and holding your own during what could be a very difficult period. On the other hand, if your time horizon is more than 3 years, if you hope not to have to touch the money, of course, if you need it to an emergency, you always have access to it, but if you hope not to touch it for more than 3 years, then we often recommend the total return strategy, because as we see the storm clouds, as our research shows that we're getting deeper into the credit contraction, we can tactically change our portfolios and get quite defensive, even with our total return strategy, and protect a lot of that downside exposure. And then when it's time for a rebound, the total return strategy has a better long-term risk-adjusted return expectation than the conservative strategy.
Excellent. Okay, great. That is all the questions that we have time for. So that will do it for us for this first quarter of 2024 webinar. And we want to thank our clients for their confidence that they placed in our firm. So on behalf of Steve and everyone here at 3Edge, thanks for listening.